Hello, everyone, and welcome back. Today, we are diving deep into a topic that is often the unsexy, invisible engine room of wealth creation. In the world of real estate, your provisions, your fuel, your lifeline is the mortgage. Most of us listening are regular wage earners. We're the middle class. We aren't buying properties with suitcases full of cash. We rely on leverage. And here is the hard truth. The quality of your loan determines the quality of your investment. If the financing is bad, the investment is bad. If the financing fails, the dream dies. I've been reviewing case files recently, and I've noticed a pattern. There are specific, recurring landmines that blow up mortgage applications right at the finish line. Today, I'm going to walk you through these landmines so you can defuse them before they destroy your deal. We're going to cover everything from the secrets of your credit file and the trap of cash flow renovations, to the harsh reality of bank valuations and the age-old problem of, well, age. So, grab a coffee, maybe a notepad, and let's get into the nitty-gritty of why loans fail. Part 1. The silent killer, your credit report. Let's start with the foundation. The very first thing any lender looks at is your credit report. Now, I know what you're thinking. I pay my bills on time. I don't even have a credit card. I'm fine. This is the most dangerous mindset you can have. In the digital age, your credit report is not just a record of what you did. It's a vulnerability point for what others might have done in your name. Identity theft is rampant. We are seeing a surge in cases where a client, let's call him John, goes to apply for a mortgage. He's confident. He earns good money. But when we pull his file, we see a default. A credit card was opened in his name 2 years ago, maxed out for a few $1,000s, and never paid. John had no idea. Here is the nightmare scenario. You find out about this after you've signed a contract to buy a house. Now you're on a deadline. You need finance in 14 or 21 days. But fixing a fraudulent default is not a quick fix. You call the debt collection agency. They don't believe you. You go to the police. They tell you it's a civil matter or tell you to file a report online with the cybercrime division. You are stuck in a bureaucratic loop. The bank won't lend to you until that black mark is gone, but the police won't give you the case number the bank needs without a formal investigation, which takes time you don't have. The takeaway: before you even look at a house, get your broker to pull your full credit file. Do not assume it's clean. The late payment trap. There's another layer to this. It's not just about fraud, it's about discipline. We now have what's called comprehensive credit reporting. In the past, the bank only knew if you defaulted. Now, they can see your repayment history for the last 24 months. Did you miss a credit card payment by 15 days because you were on holiday? Did you forget to transfer cash into your direct debit account for your car loan? It shows up. To you, it was a simple oops. To a lender, it signals financial distress. Interestingly, the big four banks might overlook a tiny slip-up if the rest of the application is strong. But smaller lenders? Second-tier banks? They're often algorithm-driven. If the computer sees a late payment code, it's an automatic decline. They value your credit score more than your loyalty. So, treat your repayment history like a resume. It needs to be spotless. Part 2. The property itself, when the house is the problem. Moving on. Let's say your credit is perfect. You're approved, right? Not necessarily. Sometimes, you're not the problem. The house is the problem. We see this a lot with investors who are obsessed with positive cash flow. They find a property and think, great, I'll put up a partition wall here, turn the living room into a 4th bedroom, and rent it out room by room to students or construction workers. Here is the issue: illegal renovations. If you have turned a 3-bedroom house into a 5-bedroom boarding house without council approval, the bank will hate it. Why? Because if you default, they have to sell that house. And they cannot sell a house with illegal structures. When you apply for a loan, big banks might just do a desktop valuation. They look at data online and say yes. That's the dream. But sometimes, the system triggers a full valuation. A valuer actually goes to the property. If they walk in and see unapproved kitchens, partition walls, or unsafe electrical work, they will flag it. The bank will say, "We are not lending on this security." Suddenly, you need to pay 100% cash, or you lose the deposit. The pool fence issue. This sounds trivial, but it kills deals constantly. Swimming pools. If a property has a pool, it must have a compliant safety fence and a valid compliance certificate. If the valuer goes out and sees a pool with a broken gate or no fence, they will mark the property as uninhabitable or non-compliant. The bank will withhold settlement. They might say, "We will lend you the money, but we are holding back $20,000 until you fix the fence." If you're tight on cash, that holdback can ruin you. Big banks might accept a letter of undertaking promising to fix it. Smaller lenders? They will likely just say no until it is done. And you can't fix a fence on a house you don't own yet. It's a catch-22. Part 3. The income mirage, stability versus cash. Let's talk about money. Specifically, how you earn it. There's a huge difference between how you view your income and how the bank views your income. The contractor switch. Here is a classic scenario. You work in IT. You're on a salary earning $100,000. You get an offer to become a contractor. The daily rate is amazing, $500 a day. You do the math, and it looks like you'll be making $130,000 or $140,000 a year. You take the job, thinking you've increased your borrowing power. Wrong. You might have just destroyed it. To a bank, moving from a permanent employee to a contractor is a risk. You have lost your sick leave, your holiday pay, and your job security. If your contract is new, or if it has a short end date, many banks will classify you as self-employed. Suddenly, they don't want to see one pay slip. They want to see 2 years of tax returns as a contractor. If you've only been doing it for 3 months, you effectively have zero income in their eyes. You have to wait until you have a track record. The commission and bonus trap. The same logic applies to sales roles. Real estate agents, car salesmen, recruiters, listen up. You might have a base salary of $50,000, but you make $100,000 in commissions. You tell your broker, "I earn $150,000. Inexperienced brokers might say, "Awesome, let's buy a mansion." Experienced brokers will ask, "How long have you been earning that commission?" Banks view commission and bonuses as unstable income. Generally, they need to see a 2-year history of that bonus. They will take the average of the last 2 years, or the lower of the 2 years. If you made $20,000 in bonuses last year and $100,000 this year, they won't use the $100,000 figure. They will likely use the average or maybe even the lower figure depending on the bank's policy. If you haven't been in the role for 2 years, they might discount that $100,000 to zero. This comes as a massive shock to people who have already mentally spent that money on a mortgage repayment. Part 4. The valuation gap, off the plan in house and land. Now, this is a section that breaks hearts. We need to talk about valuations, specifically regarding off-the-plan apartments and house and land packages. The off-the-plan nightmare. You walk into a display suite. The sales agent is charismatic. They show you a glossy brochure for a new apartment. They say, "Buy now for $600,000. By the time it's built in 2 years, the next stage will be selling for $650,000 and a stage after that for $700,000. You'll make equity while you sleep." It sounds logical, but here is the reality check. When the building is finished, the bank sends a valuer. The valuer does not care what the developer is charging for the next stage. That is a marketing price, not a market price. The valuer looks at comparable sales, resales of second-hand units in the area. If used apartments nearby are selling for $500,000, the valuer will value your new apartment at $500,000. But your contract says you have to pay $600,000. The bank will lend you 80% of the lower figure, which is the $500,000 valuation. That's a loan of $400,000. You owe the developer $600,000. You now have a $200,000 shortfall that you have to cover in cash. If you don't have it, you lose your 10% deposit and you can be sued for damages. House and land packages. The same thing happens with house and land packages. You buy a block of land for $400,000 and sign a build contract for $400,000. Total cost, $800,000. The bank assesses the land. Maybe the land is fine. Then they assess the build contract. Builders often inflate build costs with marketing fees and commissions. The valuer sees a standard 4-bedroom house and says, "This house on this land is only worth $700,000 in the current market." Again, you have a shortfall. You have to bridge that gap with your own cash. Always remember, price is what you pay. Value is what the bank thinks they can sell it for if you go broke. They are rarely the same number in new developments. Part 5. The Age Cliff Exit Strategies. Another factor that catches people off guard is age. Australia has strict laws against age discrimination. You can get a loan at 60 or 70 if you can prove you can service it. However, the bank has a duty of care to ensure you don't retire with a massive debt you can't pay. Let's do the math. Standard mortgages are 30 years. If you're 30 years old, a 30-year loan takes you to age 60. No problem. You're still working. But what if you are 50 years old? The bank assumes a standard retirement age, usually 70 or 75. If you are 50 and they expect you to retire at 70, they might only give you a 20-year loan term. A 20-year loan has much higher monthly repayments than a 30-year loan because you're compressing the principal repayment. Higher monthly repayments mean your borrowing capacity drops drastically. A client might earn enough to service a $600,000 loan over 30 years. But over 20 years, their income can't support the higher payments. The loan is declined. This happens frequently with divorced couples or late starters looking to buy their forever home in their 50s. The solution? You need a clear exit strategy. If you're older, you need to show the bank how you will pay off the debt when you stop working. Will you sell an investment property? Do you have a massive superannuation balance that can clear the debt? Without a documented, plausible exit strategy, age becomes a barrier not because of discrimination, but because of mathematics. Part 6. Strategy and Recommendations, the tier system. So we've covered the problems: credit, property, income, valuation, and age. What is the solution? I want to leave you with some strategic advice on choosing a lender. In the mortgage world, we generally have the big four banks and their subsidiaries, and then we have the non-banks or private funders. My advice, stick to the majors if you can. If your profile is clean or even slightly complex but explainable, aim for the major banks. They are harder to get into, their credit policies are stricter, but once you are in, life is easier. Their interest rates are competitive, their fees are lower, and they offer stability. They solve 90% of the problems we discussed simply by having better systems and fair long-term treatment. The trap of the easy yes. There is a temptation, especially when you face rejection, to go to a non-bank or a private fund. You might see ads saying, bad credit, no income proof, no problem. Brokers might push these because the commissions are high and the approval is easy. They don't check your income as strictly. They don't care as much about the credit score. But you pay a heavy price. Literally. The interest rates with private lenders can be 2%, 3%, or 4% higher than the standard rate. Let's look at the investment logic. Real estate in Australia, on average, grows about 7% to 8% per year over the long term. If your mortgage interest rate is 7%, 8%, or 9%, you are running on a treadmill. The interest is eating all your capital growth. Add in maintenance costs, council rates, and inflation, and you're actually losing money every single day you hold that property. Why take the risk of investment if the cost of debt consumes the profit? You would be better off renting and putting your cash into an index fund. Conclusion: use private lenders only as a desperate short-term bridge, a bridge loan to get you from point A to point B, with a clear plan to refinance back to a major bank within 12 months. Do not treat them as a 30-year solution. Ultra. To wrap this up, financing is not just about filling out a form. It is a strategic maneuver. You need to audit your life before you apply. Check your credit. Fix the errors. Investigate the identity theft. Pay your bills on time. Vet the property. Don't buy illegal renos or compliance nightmares. Be wary of off-the-plan valuations. Stabilize your income. Don't switch to contracting right before buying. Watch your age. Have an exit strategy if you're over 45. If you handle the soldier's rations, the finance, correctly, the battle for the property becomes much, much easier. Don't let a lack of knowledge be the reason you lose your dream home. Talk to a professional. Ask the hard questions about valuations and income shading, and try to keep your profile clean enough for a top-tier lender. That's it for today's deep dive. If you found this helpful, make sure to share it with anyone you know who is house hunting right now. You might just save them a massive headache. Thanks for listening, and I'll catch you in the next episode.